We actually made money in both markets, but we did make more money ex-US. It was an overall good year. The US was more of a momentum year, though that can be exaggerated. Momentum, when a quant does things, it's not just like, let's buy the Mag 7 or AI. It's like 1,000 stocks that are doing a little better fundamentals and price versus the others. So that was a little bit more of it in the US. The U.S. value suffered a little bit more, and that's often the flip side. But a lot of the other things we look at, some modern techniques like using ML to parse corporate statements, is it good or bad news? More profitable stocks beating low profitable stocks. They all complemented momentum. So, I was actually particularly pleased with this year because this has been going on about 5 years, so we've been on a good streak. But we had a tough period when value was really hurt in the culminating in COVID. And we did make a whole bunch of evolutions to hopefully be less dependent on that. And I feel like we're seeing the fruit of that.
You did tell the FT over the summer that you're giving more of your autonomy to the machines, right? You're letting the black box do the work. It kind of made me think of Jim Simons, right? Because he would always say, I don't know why it's telling us to do this, but we're making so much money. Is it similar with you?
Well, any comparison to Jim Simons, I will take any day of the week.
Yeah.
And in general, I tell the truth on Bloomberg, and I lie to the FT. So that quote bugged me a little bit because I actually tried to say something a little subtle. I'm pretty sure what I actually said was something like, we're giving more of autonomy to the machines. And it kind of came out as we're just surrendering whatever. We've always prided
They did use the word surrender. Yes.
We've always prided ourselves on kind of an even split between economic intuition, understanding what we're doing, and then hard data saying that this really works. Once you move into AI, you use ML to generate your signals. At some point, we can get pretty intuitive. We can understand why, in general, it's working. Jim Simons maybe was even more full automated than we are. We're still looking for intuition, but there are almost always some steps that we can't fully explain. And this bugged me, and I probably slowed us down on AI for about a year or two, just being the old cynical man saying, when you've had a philosophy that's worked for you for near 30 years, altering it is scary. But somebody said on the team, which I thought was just brilliant, it's such a simple statement. If you always got simple-ish intuition out of what AI was doing, what the heck is AI doing? Is it doing anything extra? Like we use AI, again, to parse corporate statements. I'm going to get very geeky, and you're going to get mad at me.
No, I like it.
It takes every corporate statement and represents it as a whole set of numbers that represent that. Then you do empirical analysis saying, how does this set of numbers tend to predict returns going forward? You confirm that it's very intuitive because it looks like other short-term momentum indicators. It's just better. But that stage, what do those numbers actually mean? Yeah, I get a little Jim Simons about that. And even I'm not the most tooled up guy at AQR anymore. I'm going to hit 60 next year. I know what we're doing, but there are much better people than me. And you go to them, what do those numbers mean? And they go, it works. So there is a Jim Simons aspect, but unlike perhaps Jim, we do still insist on at least having an idea of why it's working, some intuition.
Some of that, though, is kind of replacing work I guess people could do, because you could have someone, it would take an absurdly long amount of time, but come through all of the earnings calls and assign certain values to it. What's the difference between that and what, for example, Ken Griffin has pushed back on, saying that like Gen AI can't actually produce alpha? Is it just being additive, or is it actually giving you signals that you can glean alpha out of it?
Okay. I'm always a little terrified if I disagree with Ken. But a lot of what we're using AI for is to improve existing things in spirit that we were doing anyway. Take the earnings call example. No, we're quants. We were never going to have an army of analysts, and nobody does this. Nobody can have an army of great analysts who looks at all 5,000 stocks. But quants have been parsing earnings statements forever. They used to use, and some still do, very simple methods where you have a table of words and phrases, and you just count them up. Like good phrases, bad phrases, and you get a score. And you improve that table over time. An example might be the word increasing is a +1. I hope you can see the immediate problem. If the actual sentence was massive embezzlement is increasing, that was our bad. Now, quant can survive that because if it's wrong 47% of the time, even if it looks stupid 47% of the time, 53 is still winning. What we do in AI there, we think of just it's doing that considerably better. It's not magic. I didn't hear Ken's comment, but I would be with him if he's pushing back on the often overhyped kind of, we just turned AI on and let it go, and now we have a 3-sharp ratio. So I'm guessing I agree with him, and I'm also,
like
I feel much safer agreeing with him too.
He said it can increase productivity, but when it comes to generating alpha, it falls short. So maybe it generates a little bit of alpha. And also, you have your own model, right? You have your own AI, which maybe is better than Ken's AI.
Well, I'm going to go with that.
Yeah.
I like that. I didn't say it.
By the way,
said it.
I wonder, with all this talk, we were just speaking with Alberto Masalam from the Fed about the data blackout, right? Does that give you an edge?
That's a tough question. It didn't seem to affect us very much. It wasn't a huge few weeks, but we made money over the shutdown where, last I checked, it could have changed in 8 minutes, but we were making money today with the, so we are supposed to be neutral to most of these things, and it did work out that way. But we did have to make a lot of kind of one-off decisions on, we lost our data source. We want to see revisions to GDP, to see it in our trend following strategies, if it's getting better or worse. It was a small part of it so far. If it had gone on for a long, long time, we would have had to make some tougher decisions. Whether it hurt us because we lost some data sources, or whether it helped us because it made markets do some things we could take advantage of, because we're still systematic and have other data sources, I can't tell you. I can tell you it was a good, decent time for us.
I mean, these data sources, they're plentiful, but oftentimes they're expensive. I mean, paying up for a Bloomberg terminal and the data that gives you is not cheap. On the other hand, you have more AI sources.
The amount of money you can make with the Bloomberg terminal easily outweighs
of an important statement to make
We don't
alongside
skimp
that,
on
Matt.
Bloomberg terminals. If the main purpose on getting me on TV was to sell us more Bloomberg terminals, well done.
Cliff, you're allowed back anytime. Thank you
Okay.
very much for that. Okay, so you have more data, more expensive data, but AI to some degree, we're talking about just how much of a productivity boost it is. Does this increase the consolidation among you and your giant hedge fund peers, or is this a democratization moment?
You're asking very hard questions, so I'm always going to give you on the one hand kind of answers. Big firms who can spend a lot of money are going to have an initial advantage at this. This stuff is expensive. I don't know what my AWS bill is, but it's probably bigger than my Bloomberg bill. Don't tell Mike. All that means there is some barrier to entry. On the other hand, I don't dismiss that some 23-year-old genius who's great at AI can create a competitive model in their basement. Because they are much more tooled up. So I think it remains to be seen, but I think in the short run, it's probably an advantage to the established. And we'll just have to stay on our game and keep innovating so we beat that kid.
By the way, at the beginning of the year, if I had told you we're going to have massive protectionist tariffs that are totally uncertain and, a centralized kind of federal takeover of government, profligate deficit spending, record shutdowns, attacks on the judiciary, attacks on central bank independence, like all this stuff, wouldn't it have scared you away from this market? And I mean, in the U.S. specifically, we've done really well, risk assets.
It would have, and thank God we follow models and don't listen to me. The fact that sometimes when things are scary, it's a very good time to invest. A lot of the fundamentals on companies, like I said, profitable companies have beaten unprofitable companies, and we trade that spread. A lot of the behavioral biases have shown up again this year. The place that what you're talking about maybe has helped us is we've had a very good year. I keep talking about individual stocks. We've had a very good year in trend following. And trend following, this isn't perfect. Sometimes uncertainty can kick its butt too. But on average, it likes uncertainty. It's what the geeks will call a positively convex strategy. When things get weird, yeah, I know. I dropped the convex word.
Where's Tom Keene?
So I think it's probably net helped us. It's one of the reasons I like trend following strategies. It's self-serving. We do them. It's a product line of ours. But I like them a little more than average because I think the world has a little more uncertainty than average. You can measure that, actually. You can look at forecasts and say, are we missing forecasts by more than normal? One piece of uncertainty got resolved, hopefully today, but that's only one. But I don't think that, at the beginning of the year, yeah, it would have scared me. And had we listened to my fears, we'd be having a considerably worse year.
There have been some weird things. For you, trend following has worked. For others, it hasn't. I mean, we've gone through periods where junky kind of stuff does incredibly well, and then that quickly reverses, where momentum has worked really well in gold, and all of a sudden that reverses. A lot of people have been caught out in that. Is there some degree where markets do feel untethered to fundamentals? Because this summer you said we're back to rational investing. Are we still back to rationality?
I wish I remembered everything I said.
It's okay, because we do.
It would make this stuff so much easier. Trend following, you threw me kind of a hanging curveball, I appreciate. I'm going to summarize your question, extremely self-serving. Why is your trend following doing well when others are suffering? With an admitted humbleness that even if I think ours is better, and of course I do, or else why would I be doing it, there'll be times other versions will do better. But in the last 5 to 10 years, we've really expanded what we do in trend following. Trend following traditionally was price trend. They varied. Some people used short-term trends, went up to anywhere between 1 month and 1 year for the big four: major equity markets, major bond markets, major commodity markets, and currencies. Two things that we did was a huge research effort. One was price trend is only about half of what we do now. The other half is related to price trend, but it's fundamental or economic trends. Are things actually getting better? They go the same direction a lot. They're similar in spirit, but sometimes the price moves before the fundamentals, and sometimes the fundamentals move before the price. And the fundamental trend has worked really well this year. The other one is we've gotten really into something that the industry calls alternative trends. The deeply quantitative term for that is weirder trends. So, things like shape of the yield curve, not just the 10-year. That's been a really good trend following strategy for us this year. We trade, trend following is almost exclusively, the whole trend following world doesn't trade individual equities. We do. We trade the long short factors from quant equity. They tend to trend also. So in our trend following, we trade those, and that's been really good. So again, I joked in the beginning, I am bragging, but I know at some point pure price trend will have a phenomenal year, and things that I believe are better for the long term will make us lag too. But so far, so good. For a number of years, these changes have really made it better for us.
Last month, Paul Tudor Jones, who was saying this October, well, it was October at the time, looks very similar to October of 1999. And of course, the debate about whether or not we're in a bubble with this trillions of dollars of AI CapEx plans has been coming up a lot. What's your take on that?
Sure. Well, first on the specific AI, you generally don't go to a quant for a handful of stocks. Any handful of stocks can end up being worth it no matter what its price now. If I answered as a person instead of someone running AQR's models, I have a personal bias towards cynical, curmudgeonly value investing. So when I see just very high nosebleed valuations that need tremendous growth going forward, I personally, someone put on a little disclaimer, this is not investment advice, even though it so clearly is. I would personally at least fade that somewhat. I wouldn't, where I would be scared is a retail investor putting all their money in something like this. But I don't think we can come up with a firm opinion. In most things like this, what seems to happen is that the technology turns out to be very real. I mean, look at the internet. It's not like the dot-com bubble burst because the internet turned out to be a flash in the pan. It was just the companies were priced ridiculously. And also, by the way, they weren't the companies that actually mostly stuck around to win. It was Google and Netflix and companies that weren't part of. So my gut would say we're probably going to see something similar. Now, the way quants look at it, and we look at a spread between cheap and expensive stocks. You can use a real simple model. You can go to Fama and French and use just price to book. Or you can build a very subtle model that accounts for growth differences. At the end of 2020, at the end of COVID, we saw that spread the highest ever, higher than the dot-com bubble. I would jokingly, it's a math joke, but I'd call it the 125th percentile. The joke, of course, is there is no 125th. It's just the new 100th. But I'm trying to convey that it's even more than the last one. the way we measure it, and a lot of others, that's still quite wide versus history. This spread between cheap and expensive. But on my scale, it's like 75th to 80th percentile. I don't scream bubble at that. I scream bubble twice in my career. The dot-com bubble, and probably about a year too early, because you were always a year too early, in 2019. I wrote a piece, first one like this in 2019, saying, we're doing a little bit of extra value because things are nuts. Round trip, I think that paid off for us, particularly in long short funds where we didn't have to take anything else down to do it. But it's a hard way to make your living. So in the way quants look at bubbles, I can say we're in an expensive spread. People are paying a lot for the stocks they like, more than they usually do. That is on average a good indicator for value. It has not worked yet, and I would not say it's at bubble levels. The last thing is the overall market. The Shiller Cape is used all the time, and it is not far from perfect. But you look at a lot of other measures too. And for the Shiller Cape, we're approaching about a 40. It hit about a 45 or 46 in March of 2000, which was by far the highest we've ever seen. Maybe those famous words are right this time, that this time is different. But that gives me some nerves. A very high, by the way, valuation doesn't mean a crash is coming. It might just mean a disappointing decade. One of the dangerous things is if someone says markets are expensive, so I'll short it. And then what you get is you get positive returns for a decade, but half of what you normally get. It's not much fun to go to your client after 10 years and go, well, we lost you money for 10 years, but we lost you less money than we would on average in the prior 100 years. They don't like that.
Well, this is the thing of just how much is riding on the AI trade. I mean, you can look at it through the economic lens with increasing amounts of the GDP being spent on CapEx for the AI players. Retail investors who are participating more than they ever have before. Vad Tenef of Robinhood was talking to the FT today, basically saying we're going to allow our retail investors buy pieces of private AI companies.
Everybody wants private.
Yeah,
everybody, is this some kind
I
of
already tweeted sarcastically about that.
Okay, so you don't have anything to add, I guess, about it.
I would like to remind people that bookies are not fiduciaries. Sorry, that was a
No. Well, but that sarcasm gets at a bigger underlying point, right? That there are trends that you as a human are concerned about.
Yeah, I like that we've made this. This is me who did this distinction of me as a human versus someone who sits on top of models. I will say this: whether AI is in a bubble and whether retail is fueling that bubble is a huge issue for the overall market. For me, it's much less of an issue. Our portfolio tends to look like 1,000 longs and 1,000 shorts. We are mostly, not entirely, but mostly industry and sector neutral. I can tell you, if you look at the Mag 7, I haven't looked at the AI stocks recently, but if you look at the Mag 7, we're long and short some of them. It's not a net, our model's not entirely value, and we compare them to each other. So a concentrated market can mess up a traditional manager. It can squeeze out. One way a traditional manager makes their money is by buying good stocks, but it's also by avoiding bad stocks. But if the bad stocks all have tiny weights because the market's been squeezed and most of the weight of the market is up here, you can't really make your portfolio, you can't get a lot of relative performance out of not owning something when it's already minuscule. So there are scary things about being a long short investor. You're more susceptible if there's a short covering rally or whatnot. But one of the really nice things is we're pretty immune to these kind of issues.
I want to ask, we talk about private companies in the sense of OpenAI, like selling pre-IPO shares, but there's also private investment, which has sort of monopolized our time.
Yeah.
This year, Danny was at the center of the cockroach debate, so.
Better for worse?
What do you think about mom and pop retail investors getting access to these supposedly, like in terms of private credit, they say returns are high and stable. Like that sounds good to me. And
I think you know my answer.
Yes. But why? Because if CalPERS is doing it, shouldn't we all be able to?
Millennium and Point 72 are also getting into private markets too.
I'm scared of making predictions. I'm scared of saying AQR is not going to do this, and then 2 years later you have me in, and all I want to talk about is the new AQR private fund. I'm not above that kind of hypocrisy in the future. But I don't see that as our comparative advantage. I don't think firms should do everything they can raise money at. I think they should do everything that they think they're relatively good at. And I'm not disparaging these firms. They're very deep and they see a lot more things than we do. So they might be good at it. I've been a cynic on privates in general, not that it shouldn't be a major investment asset class. We need private investing. We need things in between public and mom and pop. We need the bid from privates for public companies that gets too cheap. We need venture capital. So they're not going away. But where I've gotten on my sarcastic high horse is the idea that they're much less risky. And that is extremely prevalent. You see a lot of institutional investors who produce a so-called efficient frontier, where they'll list like public equities at 17% annual volatility, private equities 6% annual. And all they are owning is a concentrated, slightly levered portfolio of equities. So what I worry, and I don't want to be elitist, but I think mom and pop is probably more susceptible to not realizing this disconnect. And it can lead to two things. It can lead to loading the boat with equity risk. And private credit is a little bit of a different thing, but it can lead to loading them because you don't think it's really risky because you buy these numbers. And it can lead to overpaying because even I'm not quite old enough for this, but in the 80s, David Swensen pioneering privates at institutions. If you go read his book, Pioneering Portfolio Management, all he talks about is the illiquidity premium. I get paid to own these things because no one else wants to because illiquidity stinks. If I'm right, and I have advanced this hypothesis, but it's admittedly a hypothesis, illiquidity is actually prized by many people because it makes it easier. You don't have to show, oh, AQR's down 5% that month, but they made 10% next month. Oh, that was scary. The private did the exact same thing. You just didn't see it. It can make you a better investor. I admit that.
I think you've called it the illiquidity
discount.
Liquidity laundering, I think is what
I've called it volatility laundering.
Volatility laundering.
I was trying to avoid being that mean on camera.
We're going to have to end it here, though, Cliff.
But that ship has sailed.
Perfect.